Geopolitics propel market as Europe's defense rally and dollar strength reflect Washington's strategic gravity. Global financial markets were once again drawn into the orbit of geopolitics on Thursday as European defense stocks surged to record highs, while the US dollar and oil prices firmed amid a cascade of strategically charged development, all ultimately anchored to shifting signals from Washington. At the center of the market reaction was Europe's aerospace and defense sector. The STOXX Europe Aerospace and Defense Index climbed another 1%, extending its winning streak to a fifth consecutive session. The index has already gained 13% this year and has soared more than 260% since Russia's invasion of Ukraine in 2022. Underscoring how persistent insecurity and US-led strategic recalibration continue to reshape capital flows. Investors were quick to connect the rally to intensifying geopolitical undercurrents involving the United States. President Donald Trump's renewed call for a two-thirds expansion of the US military budget sent a clear signal that Washington is doubling down on hard power, reinforcing expectation that Europe will be compelled to accelerate its own defense spending in lockstep. Markets are realizing that geopolitical risk is no longer episodic, it's structural, said Peter McLean, head of multi-asset portfolio solutions at Stonehenge Fleming Investment Management. Even if military action remains unlikely in places like Greenland, the strategic pressure to ream Europe is unmistakable. That pressure was amplified by reports that US Secretary of State Marco Rubio is set to meet Danish leader next week to discuss Greenland, a development that revived memories of Washington's earlier overtures over the strategically vital Arctic territory. Simultaneously, the seizure of two Venezuelan-linked oil tankers in Atlantic highlighted the United States' expanding willingness to exert direct leverage over energy flows or economic choke points. These moves reverberated through currency and commodity market. The dollar edged higher, with the euro flirting with an eighth consecutive daily decline, restrained only by mixed US economic data ahead of Friday's closely watched non-farm payrolls report. Oil prices, after siding earlier in the week on expectations of increased Venezuelan crude supply, rebounded as market reassessed Washington's intention. Brent crude clawed back above $60 a barrel, while US rose 0.5% to $56.30. Senior US officials signaled that long-term control over Venezuela's oil revenue remains a strategic objective, a stance that investors increasingly view as supportive of tighter supply conditions rather than immediate relief. US control of Venezuelan oil sales likely implies prolonged sanctions of restrictions, said Daniel Haynes, senior commodity strategist at ANZ. That's ultimately constructive for prices, which explains the recovery we're seeing. Attention now turns squarely to US labor market data. Investors are bracing for Friday's non-farm payrolls report, with Goldman Sachs forecasting a stronger than expected 70,000 increase in December employment and a slight dip in the unemployment rate to 4.5%. The outcome could shape expectation for Federal Reserve rate cuts later this year, even as bond market remain largely